Every year, millions of hardworking people hand over 30, 40, sometimes close to half of everything they earn to the government. Meanwhile, some of the richest people on the planet, people with billions of dollars, legally pay a tax rate lower than a school teacher. And no, they're not doing anything illegal. They're not hiding money in secret islands or breaking the law. They're simply playing by a completely different set of rules. Rules that are written right there in the open, in the tax code, but that almost nobody bothers to learn. Because here's the truth. The tax system was never designed to tax wealth. It was designed to tax workers. And once you understand how that works, you can never look at your paycheck the same way again. So today, we're decoding exactly how the rich legally pay almost nothing in taxes and the strategies you can actually learn from. Welcome to Wealth Decoded. Before we dive in, let's clear up the single most important idea, because everything else builds on it. There are two completely different types of income, and they are taxed in two completely different ways. The first type is earned income. This is the money you make from a job, a salary, wages, an hourly paycheck. And earned income is taxed at the highest rates in the entire system. Not only that, the tax is taken out automatically, before the money even reaches you. The second type is what we'll call wealth income. This is money that comes from owning things, investments, businesses, real estate, stocks. And this kind of income is taxed far more gently, sometimes at half the rate, and sometimes it isn't taxed for years, or ever. So right away, you can see the game. The system punishes earning and rewards owning. The average person lives entirely in the first category, earning a paycheck and getting taxed hard. The wealthy live almost entirely in the second, and that single difference is the foundation of everything we're about to break down. Let me put it in simple terms. If you make your money by doing work, the system treats you as a target. If you make your money by owning things, the system treats you as a partner. Same country, same rules, wildly different treatment. And nobody sends you a letter explaining this. You're just expected to work, earn, and pay, while a completely different game is being played right above your head. So let's get into the actual strategies, one by one, and see exactly how that game works. Strategy 1, they don't earn income, they hold assets. Here's something that shocks most people. Many of the wealthiest people in the world take a salary of basically zero. Famous founders and CEOs have paid themselves $1 a year, or nothing at all, and people think, well, that's just a publicity stunt. But it's not. It's a tax strategy. Because remember, a salary is taxed at the highest possible rate. So why would someone who owns billions in company stock choose to get paid a giant salary and hand half of it to the government? They wouldn't. Instead, their wealth sits inside assets, mostly stock in the companies they own. And here's the magic. When an asset goes up in value, you don't pay any tax on that gain, not a single cent, as long as you don't sell it. This is called an unrealized gain. So imagine you own stock worth $10 million, and it grows to $50 million. On paper, you just became $40 million richer. But because you didn't sell, you owe zero in taxes. The government doesn't touch it. Your wealth exploded, and your tax bill stayed at nothing. Meanwhile, the worker who earned a fraction of that through a salary got taxed on every single dollar, immediately. Let me make the contrast painfully clear. Two people both get $30 million richer in a single year. The first is a top employee who earns it as a salary and a bonus. He gets taxed immediately and could hand over 10 or more million to the government before he sees the rest. The second simply owns stock that rose in value by 30 million. He didn't sell, so he owes exactly zero. Same 30 million. One pays a fortune, the other pays nothing, and the only difference is the form the money took. This is why the truly wealthy are almost allergic to salaries. A salary is money in its most taxable form. Stock, real estate, and ownership are money in its most protected form. The rich understand that the goal is not to earn money that gets taxed. The goal is to own assets that grow untaxed. Strategy 2, buy, borrow, and never sell. Okay, but this raises an obvious question. If the rich never sell their assets and they take almost no salary, then how do they actually get cash to live on? How do they buy the mansions, the jets, the lifestyle? This is where the strategy gets genius. Instead of selling their assets, which would trigger a tax bill, they borrow against them. Here's how it works. Let's say you own $100 million in stock. You walk into a private bank and say, "I don't want to sell anything, but I'd like some cash." The bank happily says, "No problem, we'll lend you money using your stock as collateral." And they'll give you millions at an incredibly low interest rate, because to them, you're the safest borrower alive. Now here's the beautiful part. Borrowed money is not income. When you take out a loan, you don't pay taxes on it, because technically, it's not earnings, it's debt. So the wealthy get to spend millions in cash, completely tax-free, while their assets stay untouched and keep growing in the background. They live off loans, secured by assets they never sell. So while a regular person sells their labor and gets taxed, the wealthy borrow against their wealth and pay nothing. And it gets even smarter than it sounds. Think about the interest they pay on those loans. It might be 2 or 3%. Meanwhile, the assets they borrowed against are often growing by 8, 10, or more percent a year. So their wealth is actually growing faster than the cost of the loan. They're getting richer while spending borrowed money and paying no tax on any of it. Let that sink in. A regular person borrows to buy things that lose value, like a car, and pays high interest on top. The wealthy borrow against things that gain value, pay tiny interest, and never touch their principal. It's the exact same tool, debt, used in two completely opposite ways, with two completely opposite outcomes. They get all the spending power of being rich without triggering a single taxable event. Now, this is exactly the kind of insider knowledge the system hopes you never learn. If your mind is a little blown right now, do us a quick favor and hit that subscribe button. We decode how money and the wealthy really operate every single week. All right, let's keep going because the next strategies are just as powerful. Strategy 3, the business owner's playbook. This is where things get really practical because you don't need to be a billionaire to use it. When you're an employee, you earn money, you get taxed, and then you spend what's left. Earn, tax, spend. That's the order, and it's the worst possible one. But when you own a business, the order flips completely. You earn money, you spend on legitimate business expenses, and then you're taxed only on what's left over. Earn, spend, then tax. That tiny change in order is worth a fortune. Think about what a business can legitimately deduct before taxes. A portion of your car if it's used for business, travel, meals with clients, your laptop and phone, a home office, software, tools, education. Things a regular employee pays for with after-tax money, a business owner can often pay for with pre-tax money. So two people can live remarkably similar lifestyles, drive similar cars, take similar trips, but the employee pays for it all after being taxed, while the business owner runs much of it through the business and is taxed on a much smaller number. This is why the tax code is often described as a series of incentives. The government wants people to start businesses, create jobs, and invest, so it rewards those activities with lower taxes. Employees get almost none of these incentives. Business owners get a whole menu of them. Let me give you a simple picture. Imagine two neighbors who both earn the same amount and both want to drive a nice car and take a trip to a conference. The employee earns his money, gets taxed on all of it, and then buys the car and the trip with whatever is left. The business owner uses the car for business and books the trip as a legitimate work expense, so those costs come out before taxes are ever calculated. At the end of the year, they've lived nearly identical lives, but the business owner was taxed on a much smaller amount of money and legally kept thousands more in his pocket. Multiply that over a decade, and the gap between them becomes enormous, not because one earned more, but because one understood the order of operations. Earn, spend, then tax, instead of earn tax, then spend. And the beautiful part is that today, starting a small business, even a simple side business, is more accessible than ever. You don't need a factory or a storefront. A laptop and a skill can be enough to unlock a whole new category of tax treatment that employees never get to touch. Strategy 4. Real estate and the magic of depreciation. Real estate might be the single most tax-advantaged asset that exists, and the wealthy absolutely love it for one strange reason. Something called depreciation. Here's the idea. When you own a rental property, the government lets you deduct a portion of the building's value every year, as if it were slowly wearing out. It's treated as an expense, an on-paper loss, even though in reality, the property might actually be rising in value. So picture this. You own a rental that's making you real cash flow every month, real money in your pocket. But on your tax return, thanks to depreciation, that property might show a loss, which means you can collect income while legally reporting little or no taxable profit on it. You're making money in reality, but on paper, the government sees a loss, so you owe little to nothing. And it gets even better. When it's time to sell, the wealthy often use special rules that let them roll the money from one property directly into a bigger one, delaying the tax again and again, potentially for their entire lives. Think about how unusual that is. In almost every other part of life, if you make money, you're taxed on it. But real estate can hand you a monthly stream of real cash while the tax system treats you as if you lost money. It's one of the only places where the rules let reality and paperwork point in completely opposite directions and entirely in your favor. Now stack the strategies together. You buy the property using mostly the bank's money. Your tenant pays down your loan. The property rises in value untaxed. Depreciation shields the income you collect. And when you sell, you roll it into a bigger property and delay the tax yet again. Real estate lets you earn income, grow your wealth, and shrink your tax bill, all at the same time. That's why it shows up in almost every wealthy person's playbook. Strategy 5. The final move, holding until death. This is the last piece of the puzzle, and it's how enormous fortunes get passed down almost completely tax-free. Remember unrealized gains? Assets that grow in value but are never taxed because they're never sold. Well, here's the final trick. The wealthy simply never sell. They hold their biggest assets their entire lives, borrowing against them to live and letting them grow untouched. And then, when they pass away, something remarkable happens. Under the rules in many countries, the value of those assets resets to their current market value for the heirs. All those decades of untaxed growth, the tax on it can essentially disappear. So imagine an asset bought for $1 million, grown to $50 million over a lifetime. Normally, selling it would trigger tax on that $49 million of gain, but passed down the right way, that gain can be wiped clean. The next generation inherits it, and the massive growth is never taxed at all. Think about what that really means over time. The average family earns, gets taxed, saves a little, and passes down whatever survived being taxed again and again. Each generation starts almost from scratch. But a wealthy family passes down assets that were never taxed on their growth, so the next generation doesn't start over. They start on top of everything the last generation built. That's the real reason some families stay rich for 100 years, while others never seem to get ahead no matter how hard they work. It was never just about earning more. It was about understanding that the finish line isn't a big paycheck. It's a pile of assets that quietly move through time almost untouched. This is how family fortunes survive and compound across generations, while the average family's wealth gets taxed at every single step. Buy assets, borrow against them, never sell, pass them down. It's a complete cycle, engineered to legally avoid tax at almost every stage. So let's bring it all together and pull out what actually matters for you, because you might be thinking, that's great for billionaires, but what does it mean for me? Here's the truth. You may not have $100 million in stock, but the principles behind these strategies are things ordinary people can absolutely start using. First, understand the core lesson. Earned income is taxed the most, and owned income is taxed the least. So the more of your money you can shift from earning to owning, the less the system takes. Second, own assets that grow. Every dollar you move into investments that appreciate is a dollar that grows without being taxed year after year, just like the wealthy. Third, seriously consider starting a business, even a small one. The tax advantages of ownership are some of the most powerful and most overlooked tools available to a regular person. And fourth, explore real estate, because few assets let you earn, grow, and reduce your taxes at the same time quite like it does. The wealthy aren't cheating. They're simply reading a rulebook that the rest of the world was never taught to open. The rules are public. The strategies are legal. The only real secret was that most people never knew the game was being played. And notice the beautiful, frustrating simplicity of it all. Every single strategy we covered comes back to the same core idea. Own, don't just earn. The employee earns and is taxed hard. The owner acquires assets, holds them, borrows against them, shields them, and passes them on, and is taxed softly, or not at all. It's not about loopholes and tricks nearly as much as it's about which side of that line you choose to stand on. And the encouraging part is that the line is not guarded. Anyone can step across it. The moment you buy your first share, your first small property, or start your first little business, you stop being purely a worker and start becoming an owner, and the rules quietly start bending in your direction too. Now you do. Just remember, tax law is complex and different everywhere, so always work with a qualified professional before making moves. But the mindset shift is what changes everything. Stop thinking only about how to earn more, and start thinking about how to own more, and how to keep more of what you build. Thanks for spending some time with us today. If this opened your eyes, subscribe and hit that bell so you don't miss the next one. We'll see you back here next time.